Welcome to the Opening Bell Report.
Today, we're digging into a really crucial financial analysis report. This one's focused on CleanSpark Inc., ticker CLSK.
Right.
We are looking at what the report calls a massive corporate transition.
It's a huge one. It's how the company went from that, growth at all costs model.
It's a cash burning model we see all the time.
Exactly, to becoming a genuinely profitable powerhouse.
Yeah.
And the market, well, it often struggles to re-rate a company after it changed that fundamental.
And the numbers in this report, they're just staggering. We're talking about 102% year-over-year revenue explosion.
Which is incredible growth.
Incredible. But it's paired with something much, much rarer in this sector, which is a profitable diluted EPS of $1.12 for fiscal year 2025.
And that combination, high growth and profitability, that's really the core thesis here. That swing into the black is more than just a metric, it's a trigger.
A trigger for what, exactly?
For a re-rating. It validates the whole bull case because it just de-risks the entire company.
Yeah.
It means they're self-sustaining now, not always having to raise more capital.
Exactly. But there's another layer here we have to get into. Wall Street is calling their big strategic pivot into AI a potential game changer. So, okay, let's unpack this whole transformation.
Let's do it.
So let's start with that new identity. The report really frames this as the foundational narrative. Fiscal year 2025 results ending September 30th, they confirm CLSK isn't just a miner anymore.
No, not at all. They're now, as you said, a profitable powerhouse. And the timing on this is fascinating. For years, the market just tolerated losses for companies chasing market share.
Oh, absolutely.
But that era, it's over. Investors want capital efficiency now. And this analysis shows CleanSpark answering that call.
And they answered it with scale. That top-line success, the 102% revenue growth, it was driven by hitting a huge operational hash rate milestone.
50 exahashes per second.
50 EHs by December 2025. What does a number like that actually represent in this sector?
It's industrial scale. It's operational maturity. You have to think of 50 EHs not just as a number, but as this enormous specialized manufacturing operation that's just running at peak efficiency.
And doing that so quickly while keeping costs low, that's what let them switch from burning cash to generating it.
Precisely.
Which brings us back to that positive diluted EPS of $1.12. The report claims this validates them as one of the most efficient operators out there.
And if you connect that to the context on efficiency, you see why. The report links profitability directly to strong fleet efficiency.
Meaning they're getting the most bang for their buck, energy-wise.
Maximum output per kilowatt.
Yeah.
Combine that with, favorable Bitcoin appreciation, and you get the secret sauce. The real metric that shows this, though, without all the accounting noise, is adjusted EBITDA.
And what was that figure?
It hit a record high, $823.4 million.
Okay, so why do analysts prefer to focus on adjusted EBITDA for a company like this?
That's a great question. The report highlights it because it strips out these huge non-cash items, things like depreciation, that are common in businesses that spend a lot on equipment.
So it gives you a cleaner picture of the actual cash flow.
The cleanest view of the core operating cash generation. Hitting $823 million in cash shows they're managing expenses incredibly well while scaling revenue. That right there is operational leverage.
And that performance, it flows right into their balance sheet. What does the report say about their overall financial health?
It paints a picture of real strength and resilience. Total assets grew 62% year over year to $3.18 billion. Total equity is robust, $2.18 billion.
And they have that huge Bitcoin treasury.
A massive one, over 13,000 BTC. And that asset base gives them flexibility. It means they can fund future projects like the AI pivot without constantly going back to the markets.
Okay, so to prove this isn't just theory, we need to look at the raw financial data, the specific numbers for fiscal year 2025 from the report.
Yeah, these figures really show the velocity of their growth.
Right. Revenue for FY 2025 was $766.3 million. Just compare that to $378.9 million the year before.
There's your 102% growth.
Exactly. And even more impressive, operating income of $318.0 million. The analysis stresses this is a huge improvement from all those previous operating losses.
That jump in operating income is the key signal. It shows the core business, converting power into value is just highly effective. It's generating cash before you even think about debt or taxes.
The report also gives an estimated gross profit around $423 million, which it says comes from strong mining margins.
And for production context, they mined 7,746 BTC for the calendar year 2025.
So let's connect all this back to that $1.12 EPS number.
Well, to get there, you need a positive net income to comment. This is a huge milestone for any high-growth tech company. To go from needing heavy investment to actually being in the black, it validates the whole business model.
It means the company can basically pay for its own growth now.
Precisely. And to put the EPS in context, the report mentions 255.6 million shares outstanding. So that positive $1.12 shows real earnings power per share, especially when a lot of their competitors are still posting negative numbers.
And this financial health, the strong balance sheet, the $3.18 billion in assets, that's what makes their next big move even possible.
You're talking about the AI pivot.
The AI pivot, this is what the analysts are calling the game changer.
It's the forward-looking narrative. I mean, investors are always looking 6-12 months down the road. They want to see a clear path for growth that isn't just tied to the price of Bitcoin.
And this diversification into high-performance computing, or HPC, and AI infrastructure is central to that. The consensus is this is a pivotal move.
And they're not just dipping their toes in the water. This is major infrastructure deployment.
Right. The report points to one specific project driving future growth, a new 285-megawatt AI data center coming online in Texas. This isn't just another mining farm. It's an engine for a whole new business line.
And what's so strategically brilliant here is the synergy. Bitcoin miners are, well, they're masters of deploying massive power infrastructure fast.
And AI data centers are just as power hungry.
Exactly. So by coupling the two, they can optimize everything. They can shift capacity between mining and HPC depending on which one offers better margins at the time. This dual use capability is why analysts see so much continued revenue expansion.
So they're leveraging their core competency, large-scale power management, and applying it to a different high-demand vertical. It makes perfect sense. But 285 megawatts is huge.
Does the report mention any skepticism? Like, are they biting off more than they can chew?
That's a fair question, and yes, the report does address execution risk. But it ultimately trusts their track record. They've proven they can execute on large-scale infrastructure projects.
So the financial implication is massive.
It's massive. Analysts aren't just looking at the $766 million mining revenue base anymore. They're factoring in a whole new substantial revenue stream from AI services. The report is clear. They project continued expansion because of this new HPC capacity. Okay, let's bring this all back to the market reality. Because despite these fantastic results, the stock has been volatile. The price is sitting around $12.73, giving it a market cap of $3.26 billion.
And here's the dissonance, right? The analysis notes the stock is down about 46% from its 52-week high. Why the discount? The report suggests this puts the stock firmly in what it calls deep value territory.
Let's check the valuation ratios then to see if that deep value claim holds up. The price-to-earnings ratio is at a really low 11.38.
And the analysis says that's extremely attractive for a high-growth tech stock.
Yeah.
A PE of 11.38 with 100% revenue growth is practically screaming undervaluation.
What's a typical PE for a growth stock?
Oh, a typical S&P 500 growth stock might trade at 20x, 30x earnings. Some of their competitors in mining, if they even have earnings, are at 35x.
So the market is pricing this like a risky miner and not recognizing the stability from the AI pivot or the proven profitability.
Exactly. They're getting a minor discount, despite delivering tech company metrics. The price-to-sales ratio is also conservative, around 4.2x. The numbers suggest the market just hasn't fully digested this transition yet.
So what's the analyst consensus? What are the actual price targets?
The consensus is pretty straightforward. They see significant undervaluation. The average price target in the report is $24.74.
Which is almost double the current price.
It's about 94% potential upside. And the high target is even more aggressive at $31.50.
That shows some serious confidence in their long-term strategy.
It does. The analyst ratings are all bullish. Strong buys maintained by Northland, Macquarie, Chardon Capital, all in January of 2026. But there is a wrinkle.
Which is?
High short interest.
So the risk of short selling, but also the potential for a big squeeze up.
Yes, exactly. That dual dynamic. High short interest creates the potential for a powerful short squeeze. If the company delivers more positive news, especially on the AI center, those short sellers have to cover their positions, which adds massive buying pressure.
Let's pivot to the technicals then, the chart context. The analysis says the stock is consolidating around that $12.70 level.
Yeah, that consolidation is pretty common after a sharp sell-off.
Yeah.
But it's important to know the critical levels to watch.
The report identifies key support at $12.50. It says holding that is critical. On the resistance side, the targets are $13.50 and then $14. Breaking through those would signal a real momentum shift.
And zooming out, the analysis suggests the long-term trend is still upward. It's supported by what the report calls a golden cross of fundamentals.
Okay, that's not a technical chart pattern, it's a metaphor.
Right, a metaphor for the rare alignment of three key things happening at once: rising revenue, confirmed positive earnings, and that future-proof AI expansion.
That's a powerful combination. It confirms current success and a future growth plan.
It is, and it raises a really important question for you, the listener, to think about. Is the market pricing this like a risky miner when the financials suggest they're operating more like a profitable AI data center business?
And that gap, that discrepancy, is where the potential upside comes from.
That's the thesis of the report right there.
So that brings us to our final takeaway. We've seen massive revenue growth, we've seen proven profitability with that $1.12 EPS, and a clear strategic diversification into AI. All the signs suggest their efficiency is hitting the bottom line hard.
The numbers confirm the pivot, and the strategy provides that forward-looking confidence.
So what does this all mean for you? We've analyzed the financials through September 2025, but the market is always looking ahead. The final provocative thought we want to leave you with from this analysis is this. Mark your calendar for the next big data point. Q1 fiscal year 2026. Earnings are expected on February 6, 2026. What will those numbers tell us about the speed and, more importantly, the profitability of their new AI expansion strategy? Something for you to mull or explore on your own.
Don't forget to like, share, and subscribe for more.